Okay, so today is one of the more boring chapters in the book. The whole chapter is about overhead allocation. The reason that your author has devoted a whole chapter to overhead allocation is because as companies continue to automate quicker and quicker and more, we find that there are less direct costs and a whole lot more indirect costs. In fact, overhead has kind of spiraled out of control as a percentage of a unit's cost over the past few years. So there's been more and more attention focused on cost control and cost efficiency measures. And so that's why your author decided to devote an entire chapter to overhead. If you are an accounting major in your cost accounting classes, you'll have a couple of chapters devoted to overhead. In fact, you can take an entire class just devoted to overhead costing. I can't imagine another class being more boring than something like that. So we're going to kind of wiggle our way through. Know that there is a lot of calculations that go on this, but my hope is to show it to you in a rational, methodical manner to get us into a habit of doing routine calculations, and then spend a little bit more time next period thinking more deeply about how can I use this information in companies that I either work at or maybe that I'm going to invest in. Here's the agenda for today. The goal of the chapter I consider fairly straightforward. The goal of this chapter is to understand why overhead costing is important. And practically, it's can you allocate overhead using 3 different methods? And you see them listed here. We've already kind of approached the topic about why overhead is important. It's because as we live in a more automated world, the direct costs become less, and the indirect costs, which is the definition of overhead, the indirect manufacturing costs have become a greater percentage of a product's total cost. And so because of that, if we don't spend our time looking for what is causing overhead inefficiencies, then we lose profit on the bottom line. We're going to do 3 methods. You already know one of the 3. So the 3 methods that we're going to use today is a single plant-wide rate. Okay, that's the one that we've learned in a previous chapter. That's the one that we called bucks over basis, where you have dollars on the top. The company chooses one basis and shoves it down the company's throat. That means all products that go through the factory use that one single plant-wide rate. In fact, I keep writing the word single in front of plant-wide rate because I think it's important for you to understand that it is one rate. And I got a little bit of experience with this as a child. My dad worked at Hitachi, which is a Japanese electronics firm. And he ended up being the vice president with no high school education, really. What little there was, he learned in the Marines. But I wound up going to work with him several times, and I was always amazed at all the different things they made inside that factory. Later, when I got into accounting, oftentimes when we were talking about overhead, I would go back to my experience watching all these things on the manufacturing line. What that single plant-wide rate means is that the smallest little handheld television set uses the same plant-wide rate as these big screen TVs that are bigger than my house at some of these football fields. So one single rate shoved down the company's throat. GAAP says it's okay as long as the overhead gets flushed through the products. GAAP doesn't have a problem with it. But just because something is easy, you guys know this from your lives, just because something is easy doesn't necessarily make it the best choice. And that's what we find out with these overhead methods. So the single plant-wide rate is something we're already familiar with. Of course, we'll review it as part of today's lecture. That's the bucks on the top, one basis on the bottom. It's usually related to direct labor hours or machine hours. One rate, everything that is created in that plant uses the same rate. The second method we're going to look at today, which is a little bit harder, is multi-departmental rates. Multi is a prefix that means many. So basically what this means is instead of using one rate and shoving it down the company's throat, we're going to use rates for each department. So we may have a rate for the first department that's based on machine hours. If that product uses heavily mechanized labor, we may have another department that uses direct labor hours. If it's a lot of hands-on touching, we may have another department that uses some rate that we've never heard of. But it's a little bit more accurate because you're not forcing everybody under the same umbrella. But because it's more accurate, it takes some more time to do this one. And it takes a little bit more sophistication on setting up the general ledger accounts. So we're going to work on these first two mostly today. The last one was a radical new way of thinking when it came out. I remember it coming out in the late 80s. It started to gain popularity. And it is challenging because it is very expensive to implement. It's called activity-based costing because unlike the other two bases, this one seeks to identify what are the major activities involved in creating this product. And what it tries to do is take these indirect costs and almost treat them as if they were direct. So activity-based costing is very expensive to implement. However, some of the world's biggest companies have successfully done it. And what they found is that by implementing this activity-based costing, it shed a lot of light on where inefficiencies in their manufacturing operations were coming from. And so it has actually saved money in the long run if companies can get over the startup costs. We'll be talking about that one a little bit today, but because it's going to take us quite a while to do activity-based costing, we'll spend most of our second day working on that. And then as we're looking at this agenda, I want you to be thinking for testing purposes, what are the advantages and disadvantages of each of these methods? So let me stop for a second. Okay, so that's where we're headed. Let's go take a look at our handout today. And what I try and do on these handouts is just summarize as best I can what the authors told us in, I hope, easier to understand language. Okay, so again, I mentioned this, as factories become more mechanized, factory overhead has become a larger portion of the product costs. And actually, it is spiraling out of control. So people have spent more time and more money figuring out what causes these costs to happen. And is there any cost-cutting measures that we can implement that will help our bottom line, help our shareholders, and so forth? So why is this important? I mentioned Hitachi as a kid going through their manufacturing plants off the 91 freeway. Most companies make more than one product. And if you think about an electronics firm, a cell phone is very different from, again, a big screen TV that's bigger than our house. So why should products that are very different in the way that they utilize resources all be forced to use the same rate? And some people would say, we don't care. As long as GAAP accepts it, overhead is a fact of life. And as long as we can push it due to our products, we don't care how accurate it is. Well, when you make decisions like that, again, easy isn't always best. And pretty soon those costs spiral out of control. And if you don't know what's causing that to happen, that can be a recipe for disaster. So again, we are in a managerial accounting class. We aren't always interested in what is best for external users. We're more concerned about data that's available for internal users so that we can make informed decisions both on internal operations and the future of our company. What I remember, again, in my CPA days, when I was a young student coming out of college, I remember thinking these people are lunatics, these activity-based costing theorists. But what happened is they came into a company named Hewlett Packard, I'm sure you've heard of it, and those studies showed them that almost all of their products were not priced appropriately. And they were actually losing money on some products that they thought were profitable. And they should have been marking up prices like crazy on some of these printers. At the time, Hewlett Packard was almost all printers. At the time, that were costing them so much money to create. So if you don't know what the true product cost is, we don't have the ability to make good internal decisions. So that's why this chapter has been placed in the book. So again, we're going to start off with something we already know called a single plant-wide overhead rate. And this one's practical when overhead costs are related to volume. They're simply volume-based, or if a company makes one or two products. If that's the case, it's not going to be cost-effective to use these more sophisticated methods. So it is the easiest because literally for accounting purposes, you need one big cost pool. You could actually have an account called factory overhead, and you would be fine as far as GAAP is concerned. Next, again, remember the formula that we've talked about, bucks on the top. So that's total budgeted overhead costs. Remember, it's called predetermined. We heard that in another chapter because it is done ahead of time. And so the bucks is the numerator, and the basis or the cost pool is divided by whatever allocation basis a company chooses. Sometimes it's direct labor hours, sometimes it's machine hours. If it's Kinko's, it might be the number of copies. If it's Hertz, it might be something like miles. It might be miles driven because Hertz is all about renting out their cars and trucks. One rate, they use that rate, and as the product goes through the manufacturing environment, that rate is applied to all the products. And then we know at the end of the year, there's might be some underapplied or overapplied overhead. We've had that discussion. So going back to advantages and disadvantages, the advantages is all the information's at our fingertips. All we got to do is add up the overhead, either estimates or final numbers, depending on when this is being done. So the implementation is simple. It's a simple formula, and it does meet financial accounting requirements. You can use it for GAAP. The downside is just because something is easy doesn't make it best. So just because you can use something for GAAP purposes doesn't necessarily mean that you should. And what we found out is the more different the products are, the more inaccurate this single plant-wide rate can become. So let's jump in and try one. You already know how to do this, so I consider a third of this chapter to already be in your memory bank. In this problem, we're asked to first use a single plant-wide rate. So we'll start off by looking at the first example, or the first requirement, I should say, that says to compute a single plant-wide rate assuming the company allocates overhead costs based on 6,000 direct labor hours. So this calls for a single plant-wide rate. So I want you to get in the habit of writing single, because that will remind you that it is one rate shoved down the company's throat. And so we're going to go back to our bucks over our basis calculation, and the bucks is given to us. Let me put a line under here. The bucks is given to us in the very first line of the sentence of the problem as 72,000, and the basis is direct labor hours. It's important that you identify the basis that you're using, and they were expecting 6,000 direct labor hours. So go ahead and pop that into your calculator. This single plant-wide rate that they're going to use to shove down the company's throat is $12 per direct labor hour. That is requirement 1. Requirement 2 says the standard model uses 2 direct labor hours per unit, and the deluxe model uses 3 direct labor hours per unit. Compute overhead cost per unit for each model. Okay, so I'm going to go ahead. There's so many ways to set this up. I'll put my standard product here and my deluxe product here, and I'm going to list out how many direct labor hours each one uses. I'll go and multiply by that $12 rate that we got in requirement 1, and we'll answer that. So 2 direct labor hours for this one, 3 direct labor hours for this one. We'll multiply by 12, just again to leave a good trail for how you got those items. And then we'll do the math. 2 times 12. Most of you can probably do that in your head. And then 3 hours times $12 per hour. There would be the overhead cost per unit. We should properly label our work. This is requirement number 2. And then finally, they want the total product cost. Okay, so requirement number 3 is asking you for the total product cost. We know by now that the product cost is the sum of direct materials, direct labor, and factory overhead. Let me grab the factory overhead line that we just computed. So that'll come from requirement 2 there. I'll use yellow so you can see where it came from. And then materials and labor for each of these is given to us. So for the standard model, materials was 12, labor was 18, and let me move those down because I wrote them on the wrong line. And the deluxe model, 23, more expensive for materials as well as labor, and they got more of the overhead. So the total product cost, once we sum those up, that would give you the answer to requirement 3. Let me go ahead and calculate that, drag the formula over, put in my total lines, and very basic review of how we would do that single plant-wide rate. Number 2 is just providing more practice for the same concept. So we'll read it together, talk about an approach, and you can do it and we'll compare our answers. It starts off by saying Hydrosports gives us budgeted overhead cost of $420,000. There's our bucks. The company manufactures 2 types of jet skis, standard and deluxe. They give us the budgeted direct labor hours for each of those models. And they tell us that they're going to produce 100 units of one model and 100 units of the other. In this case, it looks like they are not being very specific about what the direct labor hours are for the year. In the first example we did, they gave us that. In the second example, they're going to make us work to get that. So requirement number 1, figure out how many direct labor hours they plan on using for the year. The direct labor hours for the year are computed by taking the number of units that the company plans to produce times the direct labor hours per unit, which were given to you in the problem. Simply multiply those across for each type of model they're making and add them up. And the total basis that we'll use in our calculation is 2,000 hours. Once you have that, you can go on to number 2, which asks you to compute the plant-wide overhead rate by using that calculation from number 1. So on step 2, we'll do the bucks over basis, and you'll get a rate per direct labor hour, just like we did on the previous example. So for requirement 2, you see the bucks over the basis. Notice that the basis, that yellow line item, came from requirement number 1. When we take the total bucks divided by the total basis, we come out with a rate of $210 per direct labor hour. This rate will be used company-wide to apply overhead to the various products. And then finally, once you have the single plant-wide rate, you'll be able to push it down to the 2 different models based on the labor hours incurred. Pause the video and I'll come back and show you the solution, and we'll make sure that we're on the same page. Here's the solution for requirement 3, It is computed by giving the actual direct labor hours per product, standard and deluxe, multiplied by the same rate of $210 per direct labor hour that we computed in requirement 2. Take a moment to review the solution, compare it to yours, and make sure that if you have any questions, you reach out. The next exercise gives us more practice with the single plant-wide rate. However, the author is going to show us what happens when we take a look at two different bases. Requirement 1 for Dade Metals, who manufactures patio furniture, they give us the bucks of 400,000, and they give us two different bases. The first part of the problem says there's 20,000 machine hours budgeted for the upcoming year, as well as information that there's 5,000 direct labor hours. Let's see what happens when we experiment with different bases. Step 1 will have you compute the plant-wide overhead rate. Letter A will have you compute it based on machine hours, and 1B will have you compute it based on direct labor hours. Pause the video and let's see what you get for requirement 1. Under scenario 1A, our basis is machine hours. So we take the bucks of 400,000 divided by the 20,000 machine hours that the problem told us was budgeted. So the answer to requirement 1A is $20 per machine hour. Requirement 1B asks us to swap out the bases. In other words, instead of machine hours, what would happen if we use direct labor hours? So the solution to 1B takes the bucks on the top of 400,000 divided by the basis of 5,000 direct labor hours, which was given. And when you compute that rate, the rate per direct labor hour was $80. How'd you do? The final requirement has us distributing overhead in two different ways. 2A is based on the machine hours that the product takes, whereas 2B is based on the direct labor hours the product takes. Take a look. If you want to freeze the video, please feel free to do so. And here's a look at the solutions. Based on the 100 machine hours that the first product took, the first job, 121, it would be allocated overhead of $2,000. If direct labor hours were chosen as the preferred basis, then that job using direct labor hours would have resulted in $4,000 of overhead allocated to it. This brings up a point that some students confuse. The total overhead from a GAAP perspective is the same. In other words, the bucks is the same no matter whether we're using machine hours, direct labor hours, or some other basis. It's simply the way the overhead is distributed among the products that change. It all comes out in the wash. All the overhead is eventually distributed to the products. For good managerial decisions to take place, we need to make sure that we are using the most accurate data that we have. And as you'll see soon, that's where activity-based costing may shine. As with anything else, it's always a trade-off between the cost and benefit. How much is it going to cost to overhaul the accounting system to be able to use any one of the three methods we're studying, versus what is the benefit that we will get out of doing so? If it results in more appropriate product pricing, as we'll see later, if it results in highlighting inefficiencies or waste in our production process, that's where the more complex methods will shine over this single plant-wide rate. Let's go on to the next one. Because this chapter can create some anxiety and students typically have a little bit more difficult time, I would encourage you to take a look at the PowerPoint slides. Specifically now, we're ready to move past the single plant-wide rate and take a look at how we can use multiple departmental overhead rates to improve the accuracy of our overhead allocation. So instead of having one cost pool called factory overhead, in this example, you'll see that a product goes through two departments, Department A and Department B. The beauty of this method is that each department gets to choose their own overhead rate. In this case, you'll notice a 3-step process. It's important because there's so much data in this chapter that you get yourself into a rhythm of doing something the same way each and every time. So step 1 is you need to pool the overhead costs by department. Step 2 is you need to choose a department basis. They can and often are different. Do the bucks over basis calculation by department and then use those rates to push the overhead down to the product. In this first step, you'll notice that the total overhead isn't changing. It's just been split between the two departments in this example. So we're still going to do a bucks over basis, but now we're going to be using multiple rates. In the next slide, you'll see that there's two different bases. One department uses machining and the second one uses assembly. So instead of one rate being shoved down the company's throat, in this case, each product will assume or incur two different departmental overhead rates. And in step 3, the rates that you allocated are pushed down to the product level. We'll be practicing this in the next couple of exercises. I would take a break. Know that there's a lot more data that's usually given in departmental overhead problems. And then even more still, when we get into activity-based costing, there's going to be a lot of data thrown at you. When I say this, I mean that you may need to take a mental break during lectures. Pause the lecture at one point, step away, go do something that's going to clear your head, and then come back and move on to the next rate. We'll start off with one of the easier multi-departmental rate problems. The reason I call this easier is because both of them are using the same bases. So this will give us some practice by computing multiple rates, but everything will still be computed based on direct labor hours. Because there typically is a lot of data in these problems, I would encourage you to write down the facts as you read the question so you don't have to keep going back into the written data and the numeric data. So I would encourage you to create a set of facts as you read. So let's read it together and then we'll talk about a solution. Hydrosports budgets overhead cost in the amount of $420,000 for the year. So here's the total overhead cost that they've budgeted, but this time they've split it out between two departments. It says of this amount, $240,000 is sitting in assembly and traceable to the assembly, and $180,000 is traceable to the finishing department. So they've had to overhaul their general ledger accounts to include at least two different overhead accounts. The company manufactures two types of jet skis. So again, as I'm reading, I'm listing the information down. Standard and deluxe. Budgeted direct labor hours for the standard model are 7 in assembly and 1 in finishing. So again, I'm writing the data as I read it. Budgeted direct labor hours on the deluxe model are more than that, 9 in assembly and 3 in finishing. The company budgets production of 100 units of the standard model and 100 units of the deluxe model. So here we go. We have a lot of data sitting in front of us. Requirement number 1 says, compute each department's total number of budgeted labor hours. Pause the video and see if you can do that. Basically, what you're going to be looking at is the number of units that the company has budgeted times the direct labor hours per unit in both of these departments. We'll come back with that answer momentarily. So the direct labor hours budgeted for the year would be a combination of the 2 models that this company is making, standard and deluxe, and we would take the number of units that they are budgeted to make times the number of direct labor hours per unit, and we would do that for both departments. So fairly simple multiplication. Add them up and you'll see the results in red. This means that the assembly department has 1,600 budgeted labor hours for those 100 units that they plan on making, and the finishing department has 400 budgeted direct labor hours for the year. That is our basis for requirement number 2 that asks you to compute the departmental rates. Remember, it's a bucks over basis calculation, but now instead of doing one single rate and shoving it down the company's throat, now we are exploring the possibility of having different rates in each department. The unique thing about this problem is they're both using the same bases. In the third and final step, we're using the rates that we computed in requirement 2 and pushing the cost down to the products. In each case, we're looking at 2 different types of products, standard and deluxe, and we're using the $150 rate per hour that we calculated in requirement 2 for the assembly department and the $450 per hour for the finishing department. So push it down to the products by taking how many direct labor hours each product took in each department, multiplying it out, and then double check your work. In our next set of exercises, we're going to do some comparisons. We'll take the same set of data, and on the first exercise, we'll allocate out the overhead using a single plant-wide rate. $1 over a basis shoved down the company's throat. Pause the video and see if you can do requirement 1 and 2, which basically says compute the single plant-wide overhead rate and then push it down to the products. Pause the video and let's check our answer. You should start to feel comfortable with the single plant-wide basis since we've been working on it for a while. Use this exercise to assess yourself. On 17-7, we're computing a single plant-wide rate by taking the bucks given to us in the problem and dividing by the basis, which was given to us as total direct labor hours. When we took the bucks over basis, we got a rate of $17.60 per direct labor hour. To push it down to the units, all we had to do was take the number of direct labor hours per unit and multiply by the rate that we just computed. Take a moment to check your answers, and then we're going to go do the same problem, but instead of using a single plant-wide rate, we'll go ahead and compute multiple departmental rates, and we'll check out the results of each. Using the same set of data, we're asked to compute a departmental overhead rate for molding based on machine hours and for the trimming department based on direct labor hours. So requirement number 1 is going to ask us to do 2 bucks over basis calculation, each one with a different basis. Once we compute the overhead rates for each department, number 2 will ask us to push the cost down to the unit basis. Pause the video and let's see what our solution looks like. The molding department had overhead of $240,000 budgeted for it, and it determined that machine hours was the best way to push the cost down. The trimming department, on the other hand, had $200,000 in budgeted overhead costs, but decided that they would use direct labor hours. And so you see the 2 bucks over basis calculations, and you see the answers. The molding department was going to use a rate of $15 per machine hour to push the cost down to the products, and the trimming department would use a rate of $8 per direct labor hour to push down the cost to the units. So you'll see the same 2 parts, but this time instead of using one single rate, we have 2 different rates. So what you see on the last part of the calculation is the machine hours multiplied by the machine hour rate in molding, and the direct labor hours multiplied by that direct labor rate for trimming. Check out your answers and compare those to what you received in 17-7 when you use the more simple single plant-wide overhead rate. In our final exercise of the day, we'll be doing exactly the same thing. First, the author will ask us to calculate a single plant-wide rate, and then after we do that, the author will ask us to use the same data and push overhead down based on multiple departmental rates. Take a moment to look at your Excel file, read the various requirements, there are 4 of them in this case, and then we'll come back with the answer, and as one final assessment of the first 2/3 of the chapter, let's see if you can get all the answers right. The single plant-wide rate, which is based on direct labor hours, came out to be $2.50 per direct labor hour. In requirement 2, using that rate, we pushed it down to the product cost for the desk lamp by taking the 6 direct labor hours that the desk lamp took to produce minus the $2.50 rate that we computed in number 1. That gave us a product cost of $15. In numbers 3 and 4, we are now using a departmental rate. So number 3 shows that the fabricating department used machine hours to compute its rate, and the assembly department used direct labor hours to compute its rate. The rates that were computed were $3.75 per machine hour in the fabricating department and $1.60 per direct labor hour in the assembly department. Those 2 rates then were used to push the cost down to the desk lamp. The fabricating for the desk lamp took 3 machine hours to complete. We multiplied that by the rate we computed above. And that desk lamp took 2 direct labor hours in the assembly department, so we multiplied that by the rate that we computed above. Do the math. The desk lamp came out with total factory overhead allocated of $14.45. For each of the methods that we're studying, make sure that you know the advantages and disadvantages to each. The plant-wide rate strength is that the information is readily available. Information like direct labor hours or machine hours are usually tracked. It's much easier to implement than any of the other methods, and it is acceptable for GAAP and may be used for external reporting. However, we know this, that just because something is easiest doesn't make it best, and overhead costs can be too complex to be explained by a single factor or even dual factor like direct labor hours or machine hours. Make sure you have a good understanding of the assumptions of the two methods that we've studied so far. The plant-wide rate understands that overhead costs change with the allocation base and all products use overhead in the same proportions. The departmental overhead rate method assumes that different products are similar in volume, complexity, and batch size, and that departmental overhead costs are proportional to the allocation bases that they use. We still have activity-based costing left. That will be in our next lecture. Professor Johnson signing out.